In the United States, credit cards are sold as tools of freedom, a way to build credit, access rewards, and make life more convenient. But behind the marketing, behind the smiling advertisements and reward points, there is a system intentionally engineered to keep millions of Americans trapped in long-term debt. This video reveals the truth the financial industry never wants you to understand. For decades, credit cards have been marketed as symbols of opportunity and financial empowerment. But the reality is very different. The U.S. credit card system is one of the most profitable and one of the most predatory financial structures in the world. With rising interest rates, aggressive consumer psychology tactics, and hidden corporate incentives, Americans are not meant to win in this system. You are meant to participate. You are meant to spend. And most importantly, you are meant to stay in debt. Today, we break down exactly how this system works. 1. The illusion of control. Why credit cards feel safe. Most Americans believe they control their credit card usage. They assume that responsibility, discipline, and spending awareness are enough to keep them out of trouble. But the system is intentionally designed to bypass discipline. Here's why credit cards feel safe. No immediate pain when spending. Paying with cash triggers psychological resistance. Your brain feels loss. Credit cards remove that pain, replacing it with a delayed consequence. Small minimum payments create a false sense of affordability. A $2,000 balance feels manageable when the minimum due is $40. This is not an accident. It is a deliberate psychological strategy. Reward systems distract from the real cost. Points, cashback, miles. These feel like free benefits. But in reality, customers who chase rewards statistically carry more debt and pay more interest. Spending becomes frictionless. One-tap purchases, autofills, subscriptions. The card companies designed them to reduce hesitation. Credit cards are not neutral tools. They are behavior-shaping devices. 2. The economic reality. Why Americans rely on credit cards. Credit cards are not just a choice, they are a survival tool for millions. Key economic forces pushing Americans toward credit cards. 1. Stagnant wages versus rising costs. Over the last decades, wages have grown far slower than housing, healthcare, and transportation costs. Credit cards fill the gap between income and basic living expenses. 2. The cost of emergencies. Most Americans cannot afford a $500 surprise expense. This makes credit cards the only accessible emergency fund. 3. Normalized consumer debt. Debt is marketed as normal. Student loans, mortgages, auto loans, credit cards. People are conditioned to believe that debt is part of adulthood. 4. The convenience trap. Even financially disciplined people use credit cards because they simplify travel, online shopping, and renting cars. In America, the system ensures you need credit cards and then punishes you for using them. 3. How credit cards actually make money. Most don't know this. Most people think credit cards profit from swipes and fees, but that is only the surface. Here's the real profit engine. Interest, APR. The average credit card APR in the US is over 20%. Some exceed 30%. This is one of the highest consumer interest rates in the developed world. Credit card companies want balances, not full payments. Minimum payments extend debt for decades. Making just minimum payments on a $5,000 balance often takes over 20 years to pay off. This is not due to irresponsibility. It is because minimums are calculated to maximize profit. Late fees and penalty APRs. One late payment can add $30 to $40 in fees, increase APR, lower credit score, reduce future borrowing power. Debt becomes more expensive the moment you struggle. Merchant fees. When you buy something, the store pays a 1 to 3% of the transaction to credit card networks. This cost is silently passed to all consumers, even those using cash. Rewards programs are funded by others' interest. Banks do not give free money. Rewards come from the interest paid by millions trapped in debt. The system is a cycle. Debt from some, rewards for others. More spending, more fees, more debt. 4. The psychological manipulation behind credit cards. Credit card companies employ entire teams of behavioral scientists to design user experiences that increase spending. Strategic techniques include credit limits engineered to feel safe. If your limit is $5,000, you psychologically feel comfortable spending around 30 to 50% of it, exactly what banks want. Statement design hides the true cost. Minimum due is highlighted. Total interest if making minimum payments is hidden in small text. Rewards trigger dopamine. Every point, mile, or cashback notification activates a reward center in your brain. This creates spending habits, not savings habits. Delayed consequences. You buy today. The pain comes 30 days later. Humans are not wired to respond strongly to delayed consequences. Social comparison pressure. Luxury advertisements and lifestyle influencers normalize spending beyond one's means. This is not lack of discipline. It is behavioral engineering. 5. The debt loop. How people get stuck for 10 to 20 years. Credit card debt often starts small. $40 on food delivery, $20 on gas, $100 at a clothing store. But high interest makes small balances dangerous. The debt loop looks like this. 1. You carry a balance. 2. Interest is added. 3. Minimum payment barely covers interest. 4. Balance stays high. 5. Emergency happens, more charges. 6. Credit limit increases. 7. Spending increases. 8. Debt becomes permanent. This loop is not theoretical. It is the reality for millions. Many Americans are in debt not because of irresponsible spending, but because the system is built for debt. 6. Why rewards are a psychological trap. Rewards cards are marketed as smart financial tools. But the truth is, people who chase rewards spend significantly more than people who don't. Why rewards are dangerous. You feel compensated for spending. You justify purchases because of points, miles. You underestimate long-term interest. You trust the card more than cash. You fall for bonus sign-up offers. Earning 2% cash back while paying 20% interest is not winning. It is losing slowly and predictably. 7. The hidden incentives. Why no one warns you. The reason credit cards remain predatory is simple. Too many industries depend on them. The beneficiaries of your credit card debt include banks, credit card networks, Visa, MasterCard, Amex, retailers, e-commerce companies, airlines and travel brands, credit bureaus, debt collection agencies, fintech apps, the U.S. government through economic growth from spending. Credit card debt generates billions in profit. No one with power wants it to end. This is why financial literacy is not taught in schools. It is not an oversight. It is profitable. 8. How Americans can escape the credit card trap. Escaping debt is possible, but requires counter strategies to defeat a system designed against you. 1. Stop using credit cards as backup income. Use them only for planned, budgeted expenses. 2. Switch to debit or cash for daily spending. Force your brain to feel the real cost. 3. Build a $500 emergency buffer. Small savings prevent big debt. 4. Pay more than the minimum, always. Even $20 extra per month dramatically reduces long-term interest. 5. Use the avalanche or snowball method to eliminate debt. Focus on highest APR first, or smallest balance first. 6. Freeze your card. Literally. Some people freeze their card in a plastic cup to prevent impulsive use. 7. Lower your APR through negotiation. Banks often reduce interest if you ask. 8. Transfer balances to lower interest cards carefully, only if you stop using the original card. 9. Create financial friction. Delete saved cards. Turn off autopay. Remove one-click buying. With structure and awareness, the trap can be escaped. 9. The bigger picture. Credit cards are not the problem. The system is. Credit cards reveal a deeper truth about the U.S. economy. The cost of living forces people into debt. The financial system profits from that debt. And the economy grows because of that debt. You are told to be responsible, but responsibility cannot counteract a system engineered for profit. The credit card industry is not an accident. It is a business model built on predictable, long-term consumer debt, and once you understand the mechanics behind it, everything changes. Credit cards are not just pieces of plastic. They are financial instruments designed to shape behavior, generate profit, and keep you participating in a system built on spending. But knowledge is power. And when you understand how the system is designed, you can finally break free from it. If you want more deep analysis about credit scores, interest rates, debt traps, and hidden economic mechanisms inside the U.S. financial system, like this video, subscribe to The Mortgage Trap. Turn on notifications. A new episode every week on Rai o San Paulch Maon, designed to protect your financial future.